Welcome once again. This is Pinnacle Professional College, and today we will be bringing you another classic lecture on corporate governance. We'll be talking about international statements of corporate governance. In our previous lecture, we did touch on some international statements of corporate governance, and today we'll be focusing on the OECD principles. OECD principle. So we'll be trying to explain what OECD is, if you already don't know what it is, and then we should pick it up from there. So the OECD principles are published by the Organization for Economic Cooperation and Development. They are published by the Organization for Economic Cooperation and Development. So that's what OECD stands for, Organization for Economic Cooperation and Development. And basically what they are intended to do is they are intended to assist governments to improve their legal, regulatory, and institutional frameworks for corporate governance. That's what the OECD principles seek to do. And they also help in providing guidance to stock exchanges, investors in companies on how best to implement best practices when it comes to corporate governance. So two key functions here. They assist governments, right, to improve institutional frameworks for corporate governance, right? Because when corporate governance procedures are solid in a company, it attracts investments, businesses begin to grow, they are run efficiently, and it helps the nation in that sense when they are strong and profitable companies. So you have number one, they assist governments and improve the institutional frameworks for corporate governance. And number two, they provide guidance to stock exchange, investors, and companies on how to implement best practice in corporate governance. Now, so what are these OECD principles? We said OECD is Organization for Economic Cooperation and Development. So what are these OECD principles? The principle number one is ensuring the basis for an effective corporate governance framework. Ensuring the basis for an effective corporate governance framework. That's the first principle, and we'll be delving more into these principles. So ensuring the basis for an effective corporate governance framework. Now, you can understand why this is the first principle, right? Because we are establishing a baseline. So first things first, you need to ensure the basis for an effective corporate governance framework. Principle number two, the rights and equitable treatment of shareholders and key ownership functions. That's the second principle, the equitable treatment of shareholders. The third principle is around institutional investors, stock markets, and other intermediaries. The fourth principle is the role of stakeholders in corporate governance. Fifth, disclosure. Sixth, the responsibilities of the board. So this is the content of the OECD principle. Now let's take principle one, which is ensuring the basis for an effective corporate governance. Now, when we look at that, this principle is basically concerned with the framework for good corporate governance that is provided by the stock market and financial intermediaries, right? It is useful to think about this principle in terms of countries that fail to provide transparency in markets or stock markets that function efficiently or effectively. So that's principle number one. That's principle number one. Principle number one is basically focusing on establishing a baseline, right? Establishing a baseline or a basis for effective corporate governance. Before embarking on anything, we need to establish the basis for it. What is the basis for this? Why are we doing this? Right? And so the principle here is concerned with providing a framework, a structure, for good corporate governance, and which is intended to solidify our stock markets, our companies, our public institutions, our financial intermediaries, and ensure that there's transparency in the market, ensure that there's transparency in the market. When you move on to principle number 2, principle number 2 is concerned with the basic rights of shareholders. Principle number 2 is concerned with the basic rights of shareholders. So what are the rights of shareholders? Right? What are the rights of shareholders? Let's look at it very carefully. The first right of a shareholder is that they can transfer ownership of their shares. They own the shares and they can transfer it. That's one. Right. They also have the right to receive regular information about the company. Right. They also have the right to vote at general meetings. They have the right to share in the company's profits. They have the right to remove directors from the board. And they have the right to participate in decisions about executives' remuneration. So that's principle number 2. Principle number 2 focuses on the rights of shareholders. And we've mentioned extensively some of the rights. Very, very important. These are important rights of a shareholder. Now, if you move on to principle number 3, this principle is concerned with the responsibilities of institutional investors. The responsibilities of institutional investors, such as pension funds, insurance company funds, to ensure that good corporate governance is applied by these companies, right? We are looking at the responsibilities of institutional investors. When we talk about institutional investors, it's basically institutions or companies that invest. They have large amounts of money and they invest on a large scale. So pension funds, insurance company funds, etc. These are institutional investors, and even hedge funds as well. Then you look at principle number 4. Corporations should recognize that the contributions of stakeholders constitute a valuable resource for building competitive and profitable companies. So it is therefore in the interest of these companies to ensure that there's cooperation among themselves and stakeholders. Corporate governance frameworks also should recognize the rights of stakeholders. So what are the rights of stakeholders? You are looking at things, for example, one key stakeholder is employees. So what are employee rights? That's an example of recognizing the rights of stakeholders. So principle number 4 focuses on recognizing the contribution of stakeholders. Organizations do not exist in a vacuum, right? And there are stakeholders that influence organization. So a good corporate governance framework will recognize the contribution of stakeholders and will ensure cooperation between themselves and stakeholders. As well as that, these companies should recognize the rights of stakeholders that are established by law or mutual agreements. Recognize the rights. Don't just recognize stakeholders, but their rights as well. Now let's move on to principle number 5. Principle number 5. When we talk about principle number 5, we are saying here that the corporate governance framework should ensure that timely and accurate disclosure is made on all material matters. So here you are talking about disclosures, which I explained as ongoing communication, right? So there should be timely and accurate disclosure on all material matters relating to the company's financial situation, ownership, performance, etc. The disclosure of information to shareholders is an important aspect of corporate governance. Remember, when we are talking about the rights of shareholders, one of the things we mentioned was the fact that they need, what do you call it? They need to have information. They need to have information. So they have a right to information as shareholders. So principle number 5, which is related to disclosures, is designed to fulfill that need. There should be timely and accurate disclosure. Now here you have principle number 6. The corporate governance framework should ensure the strategic guidance of the company. The corporate governance framework should ensure the strategic guidance of the company, the effective monitoring of management by the board, and the board's accountability to the company and shareholders. So this principle here relates to the functions of the board. So what are the functions of the board? Number one is essentially, basically, to act in the best interest of the company and its shareholders. They should act with diligence and due care and act in the best interest of the company. They should also be ethical and take into account the interest of the company. All right, so the corporate governance framework should ensure the strategic guidance of the company, right? And the functions of the board is essentially to serve the interest of the company and its shareholders. This is where we'll bring this lecture to an end for today. We've discussed the objectives or the 6 principles of the OECD framework. And if you haven't subscribed to this channel, please do so. Hit the notification bell so that anytime we post a video, you'll be the first to get it. Share this video with your friends and have a good day. Bye-bye.